Have you ever established certain goals for yourself, but unfortunately failed to achieve them? Were you excited and motivated in the beginning, but it did not last for very long? If yes, then it's probably because you did not have a proper plan in place. Planning and preparation are crucial aspects of life. Regardless of whether it's your personal life or even professional, without planning, you cannot get ahead. If you don't want to become friends with failure, learning to plan efficiently is important. This applies to trading as well. A trading strategy effectively states what you want to accomplish and how you want to go about doing it. It also states in great detail why you want to accomplish certain goals. Strategic plans review your abilities and skills, improve them, make the most of the resources at your disposal, and help you understand your expectations from trading. It's not just important to make good trades, but understanding why you want to make them will fuel your motivation to keep going. A strategic plan or a trading strategy serves as a compass to guide you through all the trades you make and to ensure your profitability while minimizing your risk exposure. If the only trading you try to do is earn greater profits, it opens your portfolio up to greater risks. Unless you learn to shield yourself from these risks, you cannot get ahead. A good trading strategy gives you valuable insights needed to start outlining all the different steps that need to be taken for evaluating, executing, and managing the investments you make. Before you learn to double up a trading strategy, it's important to answer a few key questions. Why do you want to start trading? What exactly does success mean to you? How do you want to attain your goals? Do you have a specific exit strategy in mind? A trading strategy essentially acts as a skeletal framework for all the trades you decide to make. Having a trading strategy is just one part of the plan. Just because you have created a strategy does not automatically guarantee success. The trading strategy must be effective and realistic for it to be efficient and successful. A strategy helps in improving your insight into your motivations as well as the goals you have established for trading. How can you develop an iterating strategy, and how does it help with trading? These are the two most common questions most beginners have while talking about strategic planning. In this chapter, you will learn about the benefits of having a trading strategy or a strategic plan before trading and how you can create one. The advantages of having a trading strategy. In life, you should always be proactive instead of reactive, and the same applies during investing as well. There is a difference between both these terms if you have never really given it any thought. Proactive means you have taken an active approach and initiative or led toward doing something or changing your situation. On the other hand, reactiveness is when you take action after a specific circumstance or situation has occurred. With strategic planning, you become a proactive trader and not just a reactive one. You cannot control all the events or circumstances that affect the price of financial tools in the trading market. However, you have the power to better manage your finances and ensure you don't suffer massive losses. You have the power to regulate your risk exposure and make the most of the finances available at your disposal. A good trading strategy helps prepare for different contingencies, reduces risk exposure, and increases the chances of earning better profits. A trading strategy helps your mind in staying focused. As a trader, you will be exposed to tons of information and data. After going through all this data and information, you need to make some decisions. When you are exposed to such information, it can soon become overwhelming and can also hinder your analysis process. This is where a trading strategy steps into the picture. It helps in understanding and fixing your entry and exit points. Regardless of how the market performs, how the instruments are doing, or how others feel about trading, you will precisely know when to enter and exit a trade. Instead of blindly following trading fads and trends in the market, you will be making trades based on your financial capacity and sticking to your plan of action. A good trading strategy helps measure your performance as well. Without measuring your performance, you cannot determine whether you have improved or not. Measuring your performance is also important for making required changes and improving yourself. Chaotic trading seldom provides any opportunities to assess how you are doing in the market. For instance, After a training period, you might realize you haven't fully utilized all the capital available at your disposal or how you manage your finances. If that's the case, a good trading plan gives you a chance to rectify all this. This point is in synchronization with the previous one. Strategic planning is important because it helps regulate your emotions. Instead of letting your emotions get the better of you, you learn to control them with a plan. When you know all the different steps you need to take, entry and exit points in the market, and the budget for each trade or the maximum loss you can withstand, making the trades becomes easier. It means instead of allowing your emotions to guide your decisions, you are using logic and facts. For instance, if the value of a stock you invested in crashes, the logical action would be to exit the market after cutting all your losses. An emotional decision would be to double down and increase your investment to compensate for the losses, believing the market will turn around. However, the second solution is riskier than the previous one. If you have a strategy, it becomes easier to stay on the right course and avoid any unrequited deviations. Similarly, there will be instances where it feels like every trade is going your way. In such instances, success can also get to your head. If you don't have a proper plan in mind, you might end up investing more than you stand to lose, believing in your hot streak. A good trading plan helps distinguish between good and brilliant ideas. If you have no idea of what you desire to achieve or your reason for the same, anything and everything that pops into your head will seem like a good idea. What do you want to invest in? How much should the investment be? And what are your reasons for this investment? These are the 3 questions you will be answering whenever creating a trading plan in order to make better decisions. After all, we all have different wants and needs, but the resources available at our disposal are always finite. Learning to make the most of these resources while working towards your goals or objectives is the key to success. Over or under trading becomes quite common if a trading plan doesn't describe your entry and exit points. If you don't make the most of the resources available at your disposal or go overboard, you will harm your finances. Always remember, you should never invest more than you think you can stand to lose on a trade. If you remember these 2 points, it will become easier for you to make informed decisions while entering the market. Now that you are aware of all the different benefits associated with establishing a trading plan, it's important to create one. Always remember that it's not just about creating a good plan. You should follow it as well. A plan without any action following it does not amount to anything. Next time, whenever you are creating a trading plan, you need to create it such that it fits your needs and requirements. Forget about everyone else for now. Instead, focus purely on yourself. As long as the plan makes sense to you, it's good. There is no one formula or one-size-fits-all approach when it comes to creating strategic plans for trading. It is quite personal and will differ from one person to another. Before you start creating a plan, there are some things you should always consider. Is there anything specific you want to achieve while trading or investing? Do you need a trading plan to get the hang of your finances? Do you want to create an additional source of income? Do you want to establish a retirement fund or an emergency fund? Do you want to secure your child's future? Are you wondering what all these questions are? These questions will give you better insight into your reasons for trading. You should always have the motivation or an internal desire that pushes you to take action. Defining what you want to accomplish influences all your financial decisions. Once you are aware of this, your internal motivation commands, which is important to understand your risk tolerance. To determine your risk tolerance, here are some simple questions that you should answer. Would you call yourself a risk taker? Are you a conservative investor? What is your usual orientation towards risks? How do you determine whether the investment decision you're making is good or not? Will any other aspect of your life be affected if you assume more risks? Once you have answered all the questions, you will be more aware of your motivations and risk tolerance. Once you are aware of these 2 aspects, it's important to identify the challenges that stand in your way. A good trading strategy is seldom complicated and is always effective. Without efficiency, there is no purpose in creating a trading strategy. It doesn't mean you should never use any complex trading techniques. A good trading strategy is seldom complicated and is always effective. Without efficiency, there is no purpose in creating a trading strategy. It doesn't mean you should never use any complex trading techniques. Rather, go about it smartly. Instead of overwhelming yourself with multiple rules associated with every trade, analyze the techniques you want to use and undo them carefully. The advanced trading strategy is ideal for veterans and not beginners who are just dipping their feet into the waters of options trading. Never forget to factor in your trading requirements and your level of expertise and knowledge before using a specific technique. Always remember that there is no such thing as a foolproof trading strategy. Regardless of how detailed and well laid out your plans are, certain events and circumstances or happenings will always be out of your control. All you can do is to ensure that you can adjust yourself to all these changes. The strategy you develop should also be updated from time to time. If not, it will become obsolete. With time, your needs and requirements, investment criteria, and financial objectives will also change. So, the trading strategy should account for all this and accommodate your current requirements. Depending on the existing conditions in the market, you might have to change or modify a specific trading strategy. Before you go ahead with a trading strategy, don't forget to test it at least once. This is where demo accounts step into the picture. These days, several online platforms offer virtual simulations to test trading strategies. You will learn more about this while selecting a broker. Before you select a broker or an online trading platform, check for all the resources that it offers, including virtual simulations and demo accounts. At times, a specific trading strategy might work for some while not for others. This is quite common and should not worry you. There is no guarantee that the strategy you have chosen will work well for you or not. Even an excellent trading strategy or plan can fail, so you should always make sure you have a backup plan. This is one of the reasons why you should never invest more than you can stand to lose. Always assume the worst and prepare for the best while trading. You will learn more about different trading strategies in the subsequent chapters. For now, let's move on to the next step of creating a trading strategy. Steps to follow. Deciding the market. The first step is to understand the market you wish to invest in. There are different types of underlying assets ranging from stocks to commodities you can invest in while dealing in the options market. So, you must conduct a couple of analyses before you decide on the options you wish to trade with. First, gather all the financial information available about the specific underlying security you wish to trade with. It helps determine your return on investment, as well as the price-to-earnings ratio. Once you do this, it is time to analyze where the investment stands according to the present market trends. It will give you a general idea of a specific asset's performance and how it might perform in the future. Another analysis you must perform is known as the sentiment analysis. It essentially means you need to understand the existing market conditions and the general sentiment of investors towards the market. A bearish or bullish market will influence the kind of trading strategy you opt for. Select the direction. Once you have zeroed in on the direction you wish to head in, the next step is to determine the kind of strategy you wish to use. It can be something as simple as a call or a put, or it could be a mix of different strategies to create a strangle or straddle strategy. Depending on your goals, the existing market conditions, and the kind of investments you wish to make, the strategy will change. Certain strategies are quite good for a bearish market, and some are good for a bullish market. Then are some strategies that can effectively be used when the market is volatile or stagnant. You will learn more about different strategies according to the market conditions in the subsequent chapters. Select an exit point. Once you have understood the kind of strategy you wish to use, the next step is to determine your exit points. Determining your exit point is an incredibly important aspect of trading. It is not only important to determine when you need to jump into the game, but you must also be aware of when you need to exit the game if things don't go as you planned. For instance, if you decide that your exit point is at 25%, then you must exit the game as soon as your option reaches the specific level, regardless of how well you think it might perform in the future. You must always stick to your trading plan and close a trade as soon as you reach the primary exit point. Apart from a primary exit point, you can also set up a secondary exit point for yourself. It acts as a buffer and gives your investment a while longer to improve its performance before you need to exit the market. Regardless of the exit point you wish to set for yourself, ensure that it isn't higher than the financial loss you can risk. Find well-broken excellence once you have followed all the steps mentioned until now. You must find a good broker or a trading platform to start trading. The options trading markets are such that you always need a third party or a platform to start trading. While trading, remember to constantly monitor and adjust the investments according to the market and conditions and your preferences. If a strategy doesn't work, don't hesitate to ditch it immediately. You can always look for something else that works. Depending on the existing conditions and the resources available, do not hesitate to change your strategy as and when needed. How to select a trading strategy. Before you start trading in options, it's important to understand why you want to do it. You should also find the right broker, discover different opportunities for trading, and create a trading plan. This is one of the most important steps if you want to make it big as an options trader. A trading strategy primarily signals when you should enter or assume a specific position in the market. Regardless of all the information you have about options, unless you have a proper strategy in place, you cannot make the most of it. A proper strategy helps you make the right decisions to improve your finances and achieve your trading goals. Perhaps a challenging part of planning a trade is to select the right strategy. This is incredibly important regardless of whether you are a beginner or a veteran in the trading game. The good news is that understanding how to select a trading strategy is quite easy if you take the following aspects into account. Start with your outlook. What you expect from the underlying security you are investing in is known as your outlook. It refers to whether you expect the price of the security to rise or fall in the future. In most types of investing, the only two outlook switches considered to be profitable are believing whether the price will increase or decrease. For instance, stock traders purchase stocks if they believe their value will increase or appreciate. On the other hand, if they believe the price will fall in the future, they will sell. In stocks, these are the only ways to earn a profit. When it comes to option trading, there are four outlooks that refer to your expectations of how the market will perform. The market can be bullish, bearish, neutral, or volatile. If your outlook is bullish, it means you expect the price of the underlying security to increase. If you believe the price will decrease, you have a bearish outlook. If you believe the price will stay relatively the same, it's a neutral outlook. A volatile outlook is when you believe the price will sway in either direction or this movement will be significant. It becomes easier to find the right strategy to trade with when you select your outlook. For instance, if you believe the price of the underlying security will show a significant appreciation, the strategy you opt for wouldn't generate profits based on small movements of security in the market. At times, traders expect the price of an underlying security to stay relatively neutral for the time being and significantly increase in the future. You can always combine the outlooks and change them according to your general style or perspective. Consider the risk. You cannot overlook the risk involved in trading. There is no such thing as a 100% safe trade. Of course, certain strategies can be used to reduce the risk, while others are extremely risky. Your approach should be based on your risk profile. As a rule of thumb, it is common to never invest more than you can stand to lose. For instance, if you can only lose $10, it doesn't make any sense to invest $20. Let go of the notion that trading in options is a way to get rich overnight. Always consider the risk-to-reward ratio as well. Usually, it's believed that the reward is directly proportional to the risk involved. It means the higher the risk, the greater the reward. So calculate the total risk you can sustain without causing any significant dents in your finances. Selecting a strategy becomes easier when you know how much you stand to lose. This is a cardinal rule of investing in any security or instrument. Never overlook it because, if you are not careful, you might end up neck deep in debt. Using spreads. Creating spreads is an important part of options trading. You will primarily be combining multiple positions to enter and exit the market. When you use spreads, it becomes easier to mitigate the risk associated with your investment options, and it also reduces the cost of investment. Using spreads is believed to be a better trading option than holding on to a single position. When you enter a single trade or position, you are investing in only a specific type of options contract. It reduces the number of transactions involved, but the commission you will end up paying on each day will be higher. Initially, it's better to stick with single positions until you get the hang of it. Once you understand the ropes of options trading, you can use spreads. Don't worry, the different strategies outlined in the next chapters will guide you through all this. Number of trades. Creating a trading account with a reputed broker is important if you want to become a serious options trader. Most trading accounts have specific limits set in place to protect the interest of the customers. It means they prevent you from assuming greater risk than you can withstand. The trading limits are also set and placed for start and regulatory purposes. Depending on the trading level associated with your brokerage account, the amount you stand to invest also depends on this. It is an important consideration when selecting a trading strategy. The complexity of the strategy. There will always be strategies of varying degrees of complexity. Certain strategies are a combination of multiple consecutive transactions, while others involve only one or two. Depending on your level of understanding, common knowledge, comfort level, and risk, the complexity of the strategy you opt for will also differ. Your entry and exit points in the market essentially determine whether you stand to earn a profit or anchor or loss. The complexity increases if there are multiple transactions and underlying securities or assets. As you start going through all the different strategies discussed in the following chapters, you will understand that some transactions are easy to make while others take a little getting used to. As with anything in life, a lot of practice is needed until you can improve your ability as an options trader. Once you have sufficient knowledge and confidence, executing complicated strategies becomes easier. Trading strategies for beginners. In the previous chapter, we mentioned that there are 4 primary outlooks in options trading. Unless you decide upon a specific one, you cannot select a strategy you want to use. In this chapter, let's look at the different trading outlooks in detail to get a better understanding of the one that suits you. Bearish outlook. Traders are believed to have a bearish outlook when they believe the price of the underlying security will diminish. Bears in the market earn a profit only by purchasing put options. The option expires worthless if there is no change in the underlying security's price. If you believe there is going to be a small drop in the price of the underlying asset, investing in put options is not desirable. If you want to take a position based on downward trend in the price of an underlying asset but don't want to risk most of the capital involved, investing in putting options and writing puts reduces the risk through cost payable upfront. To reduce the time decay on the investment made, consider writing some calls. The most common strategies applicable to a bearish market are long put, short call, bear put spread, bear call spread, bear ratio spread, short bear ratio spread, bear butterfly spread, bear put ladder spread. Bullish outlook. Unlike bears, bullish traders believe the price of the underlying security or asset will see a positive movement. A bullish outlook is one of the most common outlooks in the market. While using any bullish strategy, the obvious way to earn a profit is by investing in calls based on the notion that the price of the underlying security will increase in the future. If price movement in the market isn't much or is moderate, it is not the right strategy. If there is any decrease in the price of the underlying security, you will incur a loss. Investing in calls is a trading strategy on its own. In several circumstances, purchasing calls can be quite profitable. At the same time, there are certain disadvantages too. You will lose the entire investment if the option expires worthless, and this is a risk associated with all bullish strategies. With a bullish outlook, please be aware of the negative consequences associated with time decay. You will profit only when the price of the underlying security is significant. That said, buying calls is never a bad idea. You can always use a trading strategy to reduce the cost involved to purchase calls by simultaneously writing calls with a higher strike price. It reduces the effect of time decay on the position you are assuming in the market. While using bullish strategies, you can create credit spreads to reduce the upfront costs associated with a debit spread. A wonderful thing about using bullish strategies is it lets you assume a position that profits from any increase in the underlying asset price. Apart from this, you can also control different factors associated with an investment, like the capital needed and the risk involved. If you want to make a quick buck, be aware of the sacrifice involved. This applies to all trading strategies in the options market. The main drawback of using a bullish trading strategy is that the profit you earn will be limited to a specific amount. Since most of the trades in the options markets are based on relatively short-term movements and prices, it is not a major drawback. Holding on to a trade for longer periods means your ability to hold multiple positions should be sustainable. The most common strategies applicable to a bullish market are long call, short put, bull call spread, bull put spread, bull ratio spread, short bull spread, bull butterfly spread, bull condor spread, bull call ladder spread. Neutral outlook. If the financial tools in the market don't show any changes in price, they are known as neutral. Although this is a general definition, the term has a broader meaning in options trading. If the price of the underlying securities moves with an effect arranged or stays the same, the investor earns a profit. The first of these is known as neutral trading strategies. If there is a slight up or down movement in the price of an underlying security, it's believed to be moving sideways. When the price starts moving sideways, the security is projecting a neutral trend. The very existence of these strategies is the obvious advantage they offer. It doesn't necessarily mean the price of the securities keeps changing in the market. Depending on different conditions, the market reacts differently. If the price of underlying assets is relatively stable, you still stand to gain a profit. It means you don't have to have a bearish or bullish outlook. You can benefit from a neutral trend as well. A trade-off from these trends when the price of security doesn't move is that there is only a minor price change in either direction. If any of these outcomes occur, you earn a profit. These trading strategies give you better control over managing and mitigating your portfolio's risk. The most common trading strategies applicable to a neutral market are covered call, covered put, covered call collar, short straddle, short gut, calendar call spread, call ratio spread, calendar put spread, put ratio spread, calendar straddle, calendar strangle, butterfly spread, condor spread, short iron butterfly spread, iron condor spread, iron albatross spread. Volatile outlook. In a volatile market, you will earn profits when the prices of an underlying security show some volatility. A financial tool is volatile when it shows a significant price movement in either direction. That said, you cannot always determine in which direction the price will move. For instance, the volatility of a company stock will increase if there are rumors of takeovers or mergers. These are also known as dual-directional trading strategies. It means you stand to profit regardless of whichever direction the price moves in. For instance, you can invest in an equal number of calls and put options of the same security at a specific strike price. So you will earn a profit regardless of the direction the price decides to move. On the downside, you cannot use these strategies unless there is obvious volatility in the market. If the price movement is insignificant or close to staying neutral, you cannot apply these strategies. The most common strategies applicable to a volatile market are long straddle, long strangle, strip straddle, strip strangle, strap strangle, strap straddle, long gut, call ratio back spread, put ratio back spread, short calendar call spread, short calendar put spread, short butterfly spread, short condor spread, reverse iron butterfly spread, reverse iron condor spread. Don't be overwhelmed by looking at all the different strategies involved in options trading. Once you get the hang of it, executing these strategies and holding different positions in the market becomes easier. Remember to keep practicing whatever you learn to improve your skills as an options trader. You will learn about each of these strategies in detail in the next chapters. Strategies for bears. Bearish traders have a pessimistic outlook toward the market. They believe the financial tool's value will experience a downward swing, and they try to profit from the decline in the market value. It means bears are essentially sellers. If you have a bearish outlook toward the market, here are the different strategies you can use. Long put. This is one of the most straightforward bearish trading strategies. You simply need to purchase put options off an underlying security or asset. The expiry date of the option, the strike price of the contract, and opting for an American or European option are the three considerations when using this strategy. The upfront cost payable for acquiring put options and the potential profit you can earn are influenced by the strike price of the contract. If you are just getting started with options trading, opt for the at-the-money contracts. With these, the current trading price and the strike price are always the same for an underlying security. You can also select out-of-the-money or in-the-money contracts as well, depending on your preferences. As compared to in-the-money options, out-of-the-money options are relatively cheaper. If the value of the underlying security reduces, you will earn a profit in the long put. The greater the price reduction, the higher is your profitability. You can earn a profit by using a long put in different circumstances. The first is to use a sell order to close your position. Alternatively, you can purchase the underlying security and later sell it at the strike price. That said, you would lose your investment if the price of the underlying security doesn't go below the strike price of the options you own. While using this contract, the maximum loss you can incur is equivalent to the money spent acquiring the contract before the trade was made. Short call. While using a short call, you are selling a call option that comes with an obligation of purchasing the underlying security or asset at an agreed price sometime in the future. The profit on potential is limited if the stock is trading in the market less than the strike price at which it was sold. The risk increases if the price of the stock is more than the strike price. If you believe the value of the underlying asset will show a moderate decline, use a short call. The time decay factor plays in your favor while using this strategy, and you can benefit even if the price of the underlying asset stays relatively stable. Bear put spread. To execute a bear put spread, two simultaneous transactions need to be made in the market. The first transaction is to purchase money puts. The next transaction is to execute an equal number of monies put for a contract with a lower strike price than the previous trade. While executing this spread, ensure the contracts are both for the same underlying securities. The contracts should also have the same expiry date. Bear call spread. At times, the value of an underlying security might reduce, but the decline is steep. In these cases, a bear call spread comes in handy. If there is a moderate reduction in the value of the underlying security, you can still earn a profit. You need to execute two simultaneous contracts while using this strategy. Purchase and sell a fixed number of calls with the same underlying security or asset expiring on the same date. The only point of difference is the strike price of options contracts. You need to purchase out-of-the-money call options while selling at-the-money call options. Remember, the date of expiry and the underlying asset must be the same. Bear ratio spread. This is quite similar to the usual bear put spread. The only difference is in a bid ratio spread. The number of options contracts you will be writing and purchasing are different. Even if the value of the underlying security doesn't decrease drastically or it increases slightly, you can still use this bearish strategy due to the spread involved. You need to execute 3 simultaneous transactions to execute this strategy. The first one is to purchase money put at a higher strike price while executing other money puts at a lower strike price. Even if the value of the underlying security doesn't increase or decrease significantly, the only loss is the upfront investment of procuring the contracts. If the value of the underlying security on the date of expiry is the same as the strike price of at-the-money puts, the trade is said to be profitable. Short-bear ratio spread. This trading strategy is an advanced version of the long-put trading strategy discussed previously. If you firmly believe that the price of the underlying security will experience a drastic reduction and you are interested in reducing the upfront costs involved in procuring the options contract, you still strategize. As with any other option spread strategy, be prepared to enter simultaneous positions to use and execute the strategy. You need to enter the two contracts simultaneously, which are based on the same underlying security with the same date of expiry. However, there are two other considerations while executing such trades. The first is to remember that you need to have a higher strike price than the ones you are purchasing. The number of contracts you want to sell needs to be lower than the contracts you purchase. If you are comfortable with executing multiple contracts simultaneously, you can enter into 3 positions. Whenever you are entering any credit, remember the 2 conditions discussed here. Your ability to earn a profit is directly proportional to the ratio within the spread created. Bear butterfly spread. If you think the value of an underlying security will decrease within a specific time frame, a bear butterfly spread comes in handy. Once again, you can reduce the option and cost of investment while using this strategy. If your capital available for investment is low, use those. That said, your profitability is also relatively low. You need to execute 3 transactions simultaneously to create a bear butterfly spread. Before the execution of these transactions, select a specific price range in which you believe the underlying security will dimension value. Apart from this, you will also need to select a time frame within which this decline will happen. Once you do these right, put contracts with a strike price equivalent to the price and expiry date as per your prediction. For every 2 puts written by you, purchase 1 put with a higher strike price and another with a lower strike price. Remember, all these different options contracts need to expire on the same day. The strike price for all the different options contracts you have purchased and executed should not be spread wide apart and need to be close together if you want a profit. Bear put ladder spread. The bear put ladder spread is an advanced version of the regular bear put spread strategy discussed previously. As with any other bearish outlook strategy, your profitability increases as the value of the underlying asset falls. Once again, you need to execute multiple options contracts at the same time. As with any other spread strategy, this reduces the upfront costs involved in procuring and executing the contract. There are 3 different transactions you need to execute. This is perhaps one of the most complicated bearish strategies. The first options contract is to purchase put options with the idea of earning a profit if the value of an underlying security diminishes as per your predictions. The other 2 transactions you need to perform are writing 2 contracts for an equal number of put options. While doing this, ensure one contract of put options has a lower strike price than the other. Whenever you are executing a bear put ladder spread, insured go options are always at the money or relatively close to the money when you purchase them. One contract of options you write should be such that its strike price is equivalent to the expected decline in the value of the underlying security. In the final set of puts, you need to have a lower strike price than the ones you have executed. This brings us to the end of all the different strategies applicable to a bearish market. If you believe the price of an underlying security will reduce or the market is in a downward spiral, use any of these. Start with the relatively simple ones and get the hang of executing one contract at a time. After this, you can move on to the relatively advanced strategies. Strategies for bulls. Unlike bears, bulls have a rather optimistic outlook about the market and how it will move. Instead of believing the market will decline, bullish traders believe though the market value will appreciate. They are investing based on the notion that the market conditions will improve and the securities will perform better. In this chapter, we will look at some of the common bullish trading strategies applicable to the options market. Long call. A long call comes in handy if you believe the value of an underlying security will increase significantly within a relatively short period. Even if the price movement of the underlying asset isn't steep or quick, you still stand to earn a profit. There is only one factor you need to remember while executing the strategy: the negative effect of time decay on the value of the underlying security. The value of the asset reduces if the expiration date of the call is approaching. The risk of your portfolio is limited to the cost incurred for acquiring the call's contracts. You will profit by using the strategy as long as the price of the underlying asset increases. You have two options here. Filter out the first asset to sell the calls when there is an increase in the price of an underlying asset. The second option is to purchase an underlying asset or security at a predetermined strike price and later sell it at the current trading price in the market. You can use either of these strategies while executing a long call to earn a profit. Short put. As the name suggests, you will be selling put options in this strategy. In this, you agree to procure underlying securities at a predetermined price and date. If the value of the underlying security increases, you profit from this strategy. If the value decreases, the puts you have written need to be executed. If that's the case, you will essentially be purchasing underlying securities from the options contracts. Use this option only if you are certain that the value of the underlying security will increase. To execute the strategy right, put options that are close to the money and have a short expiry date. When you execute such a contract, you don't have to worry about any drastic movement in the value of the underlying security because the time frame is limited. Bull call spread. This is one of the most commonly used bullish trading strategies. You need to execute options contracts simultaneously. As a bullish trader, you expect the value of an underlying asset to increase. However, there will be instances where the movement isn't drastic. If the movement is drastic, with a regular long call, you cannot earn much of a profit. In such instances, bull call spread comes in handy. The first transaction was to purchase out of the money calls. The second transaction is to write an equal number of at-the-money calls. Both these contracts should be based on the same underlying asset. When you do this, a debit spread is created, which reduces the overall cost of writing and buying the calls. The strike price of both contracts you are executing should be placed close together. If the value of the underlying security increases, the trade will be profitable. Bull put spread. To use this strategy, you must execute two put options: long and short put. The long put should have a relatively high strike price when compared to the short put. The expiry date for both of these options contracts must be the same. And this strategy comes in handy whenever you believe the underlying security will experience a moderate increase in its price or its overall value will stay stable shortly. To build a bull put spread, you must sell and purchase and add the money put options based on the same underlying security expiring on the same day. Bull ratio spread. This strategy takes our regular bull call spread a step further. The flexibility offered by this strategy is greater when compared to a regular bull call spread. You need to execute 3 options contracts simultaneously. You must purchase 2 calls while writing 1 call with a higher strike price than the ones purchased. It is known as a ratio spread because you are essentially purchasing underwriting calls in a fixed ratio. As a rule of thumb, a usual ratio spread is executed in the ratio of 1 to 2. It means that for every call option purchased at the money, 2 out of the money call options need to be written. This ratio can be changed according to your investment objective and the capital available. Short bull spread. You will earn a profit by investing in such securities whose value appreciates similarly to how it would if you were purchasing call options. The cost involved in performing the transactions is reduced while your profitability increases with this strategy. Be prepared to execute two simultaneous transactions. The first transaction is to purchase calls, and the second is to write calls. To purchase calls, give the broker an open to buy order and issue a sell to open order to write the calls. Remember, no contracts should expire on the same date and must be based on the same underlying security. The number of options contracts purchased must be greater than the ones that are written. The usual ratio in a short bull spread is 3-to-1. It means for every 3 call options purchased, you need to write 1. Bull butterfly spread. This is quite similar to a regular butterfly spread. The only difference is that the outlook of the trader is not neutral and is instead bullish. Whenever the trade expects the value of an underlying security to appreciate and has a general idea of the limit, which will increase within a fixed period, this strategy is used. You can still use this strategy with limited capital because the upfront costs involved to make the required transactions are relatively low. 3 simultaneous transactions need to be executed to create a bull butterfly spread. You need to execute a call option with a strike price equivalent to the expected value of an underlying security at a specific date or its expiration. For every 2 calls that are written, purchase 1 call with the next lowest possible strike price and 1 with the next highest strike price. Once again, these are all assumptions. The money received from writing the calls covers the cost of procuring the calls. On the expiry date, if the value of an underlying asset is the same as the strike price for all the calls written, it is a profitable trade. All the calls that were written will be worthless upon expiration, and all the calls purchased will have a higher strike price, earning you a profit. However, all the calls that were purchased at a lower strike price will expire at money. Bull condor spread. You earn a profit by using a bill condor spread if the value of an underlying security appreciates within the price range you predicted. It's similar to butterfly spread, but the level of accuracy isn't as high as a butterfly spread. You need to execute 4 simultaneous transactions while using this strategy. You need to purchase the right options contract. All these contracts should be executed at once to reduce the upfront costs involved and to keep things simple. Start by deciding a specific price range if you believe the underlying asset will appreciate within a given time frame. The best way to understand this strategy is through an example. Let's assume the stock of a company is trading at $10, and you believe its price will increase between the range of $11 to $14. The 4 transactions you will execute involve purchasing and writing calls. Write calls for the strike price of $11 and execute a similar number of calls with a strike price of $14. Now, purchase call options with a strike price of $6 and $18 each. You are essentially writing a set of calls such that one will be towards the higher end of the predicted price range while the other would be towards the lower end. You are also purchasing 2 sets of called options, one with a lower and the other with a relatively higher strike price. While doing this, all the options contracts should be based on the same underlying security expiring on the same date. If the price range you predicted is close together and the contracts are executed within this range, you will be profitable. Bull call ladder spread. This strategy is an advanced version of a usual bull call spread you were introduced to earlier. If you are confident the value of an underlying security will increase, but aren't fully sure if it will increase by significant value or not, use this strategy. You need to execute 3 options contracts while implementing this strategy. Purchase calls on the expected value of the underlying security you believe will increase. Now, it's time to write 2 different sets of calls with varying strike prices. Here is a simple example to make things clear. Let's assume the stock of a company is currently trading at $80 in the market. You believe its value will increase to $90 and will not exceed this range. The first transaction is to purchase calls at money at the strike price of $80. while the second transaction has to write the same number of calls for a strike price of $90. You execute the third transaction by writing another set of options for a strike price of $92. By executing all these transactions simultaneously, the costs incurred from the first one will be offset by the money obtained from the other two transactions. By doing this, you are automatically reducing the upfront costs of executing the trades. If the value of the underlying security moves according to your predicted price range, your trade is profitable. Trading in a neutral market. The market does not always need to be bullish or bearish, as there will be instances when everything seems neutral. If that's the case, or if you have a neutral perspective towards the market, here are some strategies that will come in handy. Covered call. This is an incredibly simple strategy and is perfect for beginners. It is a combination of simultaneous purchase of stock and sale of a call options. You can use this strategy if you want to earn from the investment or wish to hold on to the chosen stocks. Don't exercise the call option until the value of an underlying asset is greater than its strike price, while the call options will be sold out of the money. You are creating a trade-off of priorities by using a covered call. Covered put. By using this strategy, you will earn a profit from an underlying stock that is short sold and whose price has not declined any further. Whenever a trader believes the value of stock or shares will reduce, it is short sold. You need to write a sufficient number of put options to cover the value of the stock you have short sold. Those two decisions need to be made while using a covered put. Both are associated with the strike price of both put options and their expiration date. As a general rule of thumb, write contracts are at the money or just out of the money to establish the strike price. You can also select a lower strike price. However, if you do this, the profits you stand to gain will be lower. Covered call caller. The best time to use this strategy is if you already own stock. Two transactions are involved in creating this caller spread. Starting by writing calls on the stock you own and then purchase the same number of put options. Both these transactions must expire on the same date. Select a longer expiration window if you believe the value of the stock seems stable in the foreseeable future. The out-of-the-money calls transacted must be higher in value than the current price of the stock in your possession. This trade will be profitable only if the value of the stock is the same as the strike price of calls executed. Short straddle. If the value of an underlying security does not undergo any drastic changes, you can use a short straddle strategy to earn a decent profit. Remember, your trade will only be profitable if the value of a specific security is within a predefined trading range. You need to write at-the-money call options coupled with add-the-money put options. Your expectation as a trader is to earn a return based on the value of the underlying security. The assumption is this value will stay stable or will not show any drastic changes. While executing the call and put options, ensure their expiry date is the same. Short gut. You can use this strategy if you believe the value of an underlying security will stay within a predefined limit for a specific period. It is quite similar to a short straddle strategy in a way. The only difference is that the price range it offers is rather wide when compared to the previous one. While using a short gut, you must execute in-the-money call options for a specific underlying security. Once you do this, you need to simultaneously execute an equal number of in-the-money call options on the same security. The expiry date of the contract will be the same. It is entirely up to you to decide whether you want to opt for a short-term or long-term expiry date. If it is a short-term date, the chances of any drastic price movements in the value of the underlying security reduce. The extrinsic value of short-term options is less when compared to long-term ones. While using this strategy, you will earn a profit only if the extrinsic value of the options reduces. The lower the extrinsic value, the lower your profitability. The calls and puts executed need to be both in the money. The strike prices must be selected in a way that they are equidistant from the existing trading price of the underlying security. Here is a simple example to understand how a short gut strategy is executed. Let's assume the current trading price for the stock of a company is $20. You believe the price will stay close to $20. In the money call options for the stock, it has a strike price of $15 and is trading at $6. Now, you need to write one contract of 100 options that will cost you $600. For in the money put options, the strike price is $25 and they are also currently trading at $6 each. So, you need to execute another contract of 100 in the money put options for a credit of $600. If you do this, you manage to create a shortcut for a total cost of $1,200 payable up front. If the stock price stays at $20, you earn a return of $200 on this investment. Short strangle. This is quite similar to a short straddle strategy. You need to execute options on the assumption they will expire out of the money to make a profitable trade. The relationship between the price and the losses while making this trade is directly proportional. Any significant movement in the price of underlying security increases the scope of a loss. Generally, it's better to select a shorter expiry period to increase your profitability. The chances of extreme or drastic price movements increase if the time frame increases. If this happens, you will incur a significant loss. You need to write out-of-the-money options and execute a trade. While doing this, you need to decide how far out of the money the options will be on the expiry date. You need to execute two contracts here. The first one is a short call with a high strike price, and the next one is a short put with a lower strike price. Calendar call spread. To use a calendar call spread, you need to execute two different trades. You must execute calls on underlying security with a near-term expiration. Once you execute this, you must purchase an equal number of calls on the same underlying security at the same strike price. The only difference is the expiry date in the second contract will be longer. The profits earned will be the result of time decay on the value of options you have purchased. When compared to a long-term option, a short-term or near-term option loses its value at a quicker rate. Call ratio spread. To execute this strategy, you must purchase options at a lower strike price. After executing this trade, you need to sell all higher numbers of options at a higher strike price. Remember, these contracts must be executed on the same underlying security. If you believe the price of an underlying asset will increase moderately in the near future, you should use this strategy. To execute the strategy, you need to purchase in-the-money or add-the-money call options while selling another out-of-the-money call options. The expiry date and underlying security will once again stay the same. If the strike price of the options increases on their expiry, you will earn a profit. Calendar put spread. To use a calendar put strategy, there are two steps you must follow. The first is to write put options on the underlying security. These options are written with the notion that the price of the underlying security will stay stable. The expiry date of the output options must be near term. Usually, it's less than a month. The second step is to purchase an equal number of options on the same underlying security with the same strike price but with a later expiry date. In a way, it's quite similar to the calendar spread, but the only difference is instead of using calls, you will be creating a spread using put options. Put ratio spread. This is a relatively complex strategy, but the results that it offers are significant. You stand to earn a profit if the value of an underlying security doesn't change. At the same time, it offers a double benefit of earning a return even if the price of the security increases regardless of how much the price changes as long as there is a price change. You need to execute the contract simultaneously. You need to buy the right put options as it creates a credit spread to improve your profitability. If the value of an underlying security is the same as the strike price of the options you have written on their expiry, your profits are maximized while using the strategy. You need to purchase options at a higher strike price and sell more options on the same security at a lower strike price. If you believe the value of the underlying assets will readily be used, but this decline is only moderate, use this strategy. It also reduces the upfront costs involved because both the trades are executed simultaneously. Calendar straddle. This strategy is a perfect mix of call and put option contracts that will be executed simultaneously. It is the combination of two strategies that were covered earlier, short straddle and long straddle. So, you need to execute transactions while using this strategy. Start by writing at the money calls with a short-term expiry date and write at the money puts for the same expiry date. After these two contracts, you need to purchase calls and puts, which are both in the money but with a later expiry date. The profitability of this strategy depends on the effect of time decay. Due to the differences in their expiry dates, it gives you a chance to earn a significant return. Calendar strangle. You must execute 4 transactions while using this strategy. Before using a calendar struggle, you must have a thorough understanding of short strangle and long strangle. You need to buy and write calls. The first step is to write out of the money call options with a near-term expiration along with out of the money puts with the same near-term expiry date. Now, you must purchase out of the money calls and out of the money puts with a later date of expiration. The contracts you purchase will be of a higher value when compared to the ones you write to the additional time value included. The strike price for the calls you write and the ones you purchase must be the same. Opt for a strike price such that it is just out of the money. The puts you have written and purchased must also have the same strike price, which is equivalent to the money you have spent on purchasing them. If the value of the underlying asset is relatively stable, the calls which have a near-time expiry will expire worthlessly. However, the other 2 calls and puts you have executed will still hold value due to the effect of time decay. Butterfly spread. 3 transactions must be simultaneously executed to use butterfly spread. Start by purchasing in the money calls and the same number of out of the money calls. While you do this, you should also execute twice the number of at the money call options. The underlying asset and the expiry date for all these contracts will be the same. The expiration time frame is controlled by you, and you can keep it short or long term according to your requirements. Setting a close expiry date is always a better idea. The strike prices for the in-the-money and out-of-the-money options must be equidistant from their existing trading price of the underlying security in the market. If the strike price is closer to the existing trading price, your profitability reduces. If the strike price is further apart from the existing prices in the market, your upfront costs increase. Short iron butterfly spread. If you believe there will be no movement or little movement in the price of an underlying security, you can use this strategy. The aim is to try and accurately predict the value of the stock on its expiry date. Your profitability in this strategy is determined by the time value of the contracts executed. This is a combination of bull call and put spreads. You need to purchase one at the money call option while buying another out of the money put option. Once again, it's important to remember the option contracts are based on the same underlying security. All these options should also expire on the same date. Iron albatross spread. An iron albatross spread is believed to be one of the most complicated strategies you can use while trading options. In this strategy, 4 simultaneous contracts are executed. These transactions are a combination of writing and buying put and call options. You need to purchase and write out of the money call and put options. The next set of transactions will be to purchase and sell out of the money call options. While doing this, the strike price of the call options you are selling must be higher than the call options you are buying. Similarly, the strike price of the put options you decide to sell should be lower than the ones you are purchasing. This difference in buying price and strike prices influences your level of profitability. Condor spread. This strategy is quite similar to an albatross spread. The primary difference between them is the strike price of the options contracts executed in the albatross spread are further apart when compared to the ones in a condor spread. You cannot make a profitable trade unless the strike price of the options contracts executed is set close together. The call and put options executed in all the transactions should be for the same security with the same expiry date. The strike prices should be such that they are equidistant from the existing market price of the underlying asset.